Welcome back to the base layer, everyone. Something changed while I was writing this video. When Alphabet announced an $80 billion equity raise on June 1st, the largest in history, the immediate question was whether they were spending too much on AI infrastructure. 3 weeks later, that question is still on the table, but now there are 3 more questions laid on top of it. Why did the co-inventor of the transformer just leave for OpenAI? Why did a Nobel laureate just walk out the door to Anthropic, along with 2 of the architects behind Gemini? Why is Alphabet joining Dow Jones Industrial Average tomorrow morning at a price that's down 16% from its all-time high? I hold this stock. It's in my DCA portfolio, and this is the most complicated month it had in years. By the end of this video, I want you to understand the raise, the brain drain, the Dow Jones inclusion, and where the stock actually sits right now. Because we're somewhere I did not expect to be this quickly. Let's start with what triggered everything. On June 1st, Alphabet filed for the largest equity capital raise in recorded history, $80 billion across 3 instruments. $10 billion came from private placement with Berkshire Hathaway, split between Class A and Class C shares, priced at 6.5% discount to market. $30 billion came from underwritten public offerings, half of it mandatory convertible preferred stock, and $40 billion is at an at-the-market program that Alphabet will drip into the market starting in Q3, when pricing conditions allow. This isn't a panic. It's a deliberate architecture. The structure is designed to manage dilution and pricing impact over time, and not front-load it all at once. The number that explains the raise, 2026 capex guidance is $180 billion to $190 billion. In the same quarter, Alphabet generated $109.9 billion in revenue, up 22% year over year. Google Cloud crossed $20 billion in quarterly revenue, growing at 63%. The cloud backlog, meaning signed contracts not yet delivered, exceeded $460 billion. Alphabet's own language in the filing, demand for AI computers exceeding the company's available supply. That's a company telling you it's capacity constrained, not demand constrained. But here's a number that complicates all of that. Free cash flow in Q1 fell 47% year over year to $10.1 billion. The spending is already compressing the financial profile the market loved. Analysts now expect EPS growth of just 6% for 2026, despite 17% revenue growth. The gap between those two numbers is the capex cycle in financial form, and it's very real. The other hyperscalers are doing this with bonds. The other hyperscalers are all doing this with bonds. Microsoft, Meta, Amazon, debt finance tax deductible, no dilution. Alphabet holds an AA plus credit rating. The bond market would absolutely lend them more. They chose equity anyway. On top of the $11 billion sterling Swiss bond raise in February, a $30 billion global bond issuance last November, and a $25 billion TPU-focused infrastructure venture with Blackstone. 2 readings, both partially true. The generous read, permanent equity capital gives you more flexibility if AI monetization is slower than modeled. The skeptical read, even with a AA plus rating, there's a ceiling on how much debt Alphabet can add before ratings agencies start pricing in leverage risk. Either way, a company that hasn't sold stock in 20 years just sold $80 billion of it. That's a data point. Berkshire's $10 billion private placement at a 6.5% discount lifts their total Alphabet stake from about $22 billion to about $32 billion, putting Google alongside American Express and Coca-Cola as one of their largest single company positions. That's a meaningful signal from a firm not famous for chasing AI narratives. But worth saying clearly, Berkshire paid a discounted price through a private placement. That's not the same signal as Buffett buying Google in the open market at full price. It's confidence plus a good entry. Both things can be true, and neither one tells you the business is going to clear $190 billion in capex with the margins the market expects. Now, to what happened after the raise. On June 18th, 2.5 weeks ago, Noam Sajir announced he was leaving Alphabet for OpenAI. Let me tell you who Noam Sajir is. He's the co-author of Attention is All You Need, the 2017 paper that introduced the transformer architecture every large language model in the world, including ChatGPT and Gemini and Claude, runs on that foundation. Google paid $2.7 billion to bring him back through an acquire hire of his startup character.ai in September 2024. They retained him for less than 2 years. The next day, John Jumper announced he was leaving for Anthropic after 9 years at DeepMind. Jumper shared the 2024 Nobel Prize in Chemistry for AlphaFold, the AI system that cracked protein folding. His departure came weeks after Google launched new Gemini models at I.O. Then on June 24th, Bloomberg reported that Jonas Adler and Alexander Pritzel, both viewed internally as critical architects of the Gemini model, are also heading to Anthropic. 4 researchers in 6 days. The market's reaction was Alphabet's steepest single-day decline in over a year. Not because these 4 individuals can't be replaced, eventually, but because it confirmed a fear the market had already been sitting with. Google may still have the infrastructure that compute, the distribution, and the cash, but it's no longer clear it has the people who can make all of that feel inevitable. Before I tell you where I'm buying, I want to be honest about what could go wrong. First, dilution is real. $80 billion in new equity is $80 billion in claims on future earnings that didn't exist on May 31st. Even structured carefully across 3 instruments, that's a smaller slice for every existing shareholder. Second, the free cash flow compression. $10.1 billion in free cash flow on $109 billion revenue is a 9% margin, well below what this business looked like 2 years ago. If $190 billion in capex doesn't convert into proportional revenue and margin over the next 12 to 18 months, the multiple the stock carries is hard to defend. Third, advertising concentration. Roughly 40% of the US digital ad market still runs through Google. It's a remarkable moat, but it's also one cyclical category, and it's increasingly under competitive pressure from AI native search services that Alphabet has to navigate without cannibalizing its own revenue model. Fourth, the talent war is structural, not episodic. Sajir and Jumper aren't the first departures. They're the most prominent ones. As long as Anthropic and OpenAI can offer IPO equity upside that a large cap stock can't, this dynamic doesn't resolve. The market is now pricing in ongoing uncertainty about Alphabet's ability to retain its research edge. Google closed $337 this week. That's down 16% from its all-time high of $402 set on May 13th. The initial drop, about 4%, came on the raise announcement in early June. The second leg down, another 6 to 7%, came on the brain drain news. Here's what's interesting. Wall Street's consensus target is now around $427 on average, across 33 analysts. With a range from $350 to $515, the most bullish models are above $450. Even the most conservative analyst target implies the stock is roughly at fair value right now. Argus Research specifically calls out a bottom range of $330 to $340, which is basically where we are. And now, on June 29th, Alphabet joins the Dow Jones Industrial Average, replacing Verizon after 22 years. At $337 a share, Alphabet carries roughly 7 times more daily influence on the price-weighted Dow than Verizon did at $46. Inclusion is symbolic, not a fundamental catalyst. Google was already in everything that mattered, but it drives passive rebalancing flows and adds a blue-chip legitimacy narrative at a moment when the stock needs one. When I started writing this video, the stock was at $366 and I said I was watching, not buying. At $337, the math is different. This is inside the range that I said I'd look to add, a pullback driven by dilution, overhang, and a talent narrative, not a deterioration in the actual cloud or search fundamentals. Google Cloud just grew 63%, the backlog is $460 billion, EPS in Q1 beat by 94%, and the business is not broken. That said, I'm not pressing the button aggressively. The free cash flow compression is real, and the brain drain story has a chapter 2 that I don't know yet. If the stock finds a floor in the 330s and Q2 earnings on July 28th today show cloud holding above 55 to 60% growth, that's my green light to add. If it breaks below $320 on fundamental deterioration rather than sentiment, I reassess the thesis entirely. This is the first time since I started this DCA that I've said I'm watching the entry window, not just watching the stock. 2 things to watch from here. First, Q2 earnings, July 28th. Everything in the bull case runs through the cloud growth. If that number holds above 55 to 60%, the capex is defensible. If it starts decelerating, this whole capital structure needs a rethink. Second, talent retention, specifically whether Google's response to the brain drain is reactive or structural. A retention package isn't a fix. What matters is whether Gemini 3.5 Pro actually ships in July, whether the products that lost their Cree architects are still progressing, and whether another wave of departure follows. The Dow inclusion is tomorrow, is the pleasant headline. The brain drain and the free cash flow picture are the harder questions. And the $80 billion raise is still the frame that ties up all of it together. Thank you for watching, and this is the base layer.